South Africa's largest steelmaker, ArcelorMittal South Africa, has come out with results today. First half diluted headline earnings per share down 63% to 166 cents, while revenue rose marginally to 16.6 billion rand. We have Nonkululeko Nyembezi-Heita, CEO of ArcelorMittal South Africa, in studio now to unpack the numbers with us. Thanks so much, Nku, for joining us today. Hello. Well, speaking to market commentators, the market wasn't expecting to see anything positive out of ArcelorMittal. But the extent of the decline that's come through, that 63% decline, has come as a bit of surprise, really disappointing. And we've got the usual culprits at play here. It seems a bit excessive. Is there anything else we need to be taking into consideration here?
Well, it actually is just the margin erosion we've been talking about for quite a long time in its full glory, which is not a pretty picture at all. A lot of what we reported today was structural issues, because if you look at the first half of 2010 and first half of 2011, more or less the same in terms of production levels, more or less the same in terms of domestic sales, which is really the bedrock of our profits. And really the two big swings were raw material prices rising, but very dramatically, and then the rand-dollar exchange rate. And remember, the rand-dollar exchange rate is not only an issue for cash that we have offshore, but it also makes that our export program unprofitable. Mm-hmm. So it really is. There are, of course, issues peculiar to South Africa and ArcelorMittal South Africa in particular, but by and large, the outcome that we have today is purely structural.
And things don't look like they're going to be getting any better anytime soon either.
Serious headwinds that we see in third quarter, which is why we put out a very weak outlook statement. And although you're starting to see some easing in coking coal prices, which is really the biggest culprit in our raw material basket at the moment, we are on quarterly contracts, and those lag. So whatever the price is today, $340 a ton, it's not going to be materially different in terms of our consumption of the coals because we have a quarterly contract. But if I just give you a sense of the numbers, we at the height had coking coal at $340 a ton against $170 a ton at the same time last year. So those are the kinds of magnitude changes that we're talking about, and energy not far behind, because we're seeing a 28% rise in that cost bucket as well.
When it comes to those input costs, coking coal, iron ore prices to consider, we've also got industrial action that we're seeing across the mining space, and that's set to see a decline in production moving forward. The picture not looking too good on that front. But to what extent do we have to consider that this isn't a context where we're seeing lower demand? It's that weaker demand that has also come to bear overall on ArcelorMittal, and that could offset possible price increases on those coking coal and iron ore price fronts moving forward.
But of course, if the real demand was there, we'd simply pass on the price increases to steel consumers, and therefore the pain would be shared. The reality today is that what we saw, actually second quarter was very good. The first half from a demand perspective was very good because there was restocking going on. Mm-hmm. We think that restocking has by and large played itself out now and come to an end, and third quarter and fourth quarter would need to be carried by real demand. That hasn't come to the fore. The consumer still has major credit restrictions, so we don't see new houses being built. Manufacturing in South Africa is really on the back foot. Infrastructure development projects, which are really the bedrock, that's the foundation that we depend on year in, year out, those projects haven't been initiated. So actually, when you look at what is positive about third quarter is very, very few things. We maintain tight controls over those costs that we can control, mm-hmm. but those are only 40% of the total basket. Now, we announced today that those rose 10% in the period just under. So on labor, on maintenance, costs are very well controlled, but we can't control steel prices.
Absolutely. And of course, this where we've still got legal hurdles that have to be overcome. And, it's an outcome of one that will affect your preferential price agreement on the one hand with Kumba that's still under place until next year. What's your confidence level looking like right now in maintaining that preferential prices in the arbitration process, or restoring your 21.4% share of Sishen mine as a mineral right at this stage?
Well, clearly you go into these fights with the downside risk very clearly in your mind, but we are quite confident that our case is solid. Mm-hmm. We are going to court on the 15th to put our side of the story, which is very, very simple, and that is, on the one side, as a matter of law, rights cannot be fractionalized in terms of the MPRDA in South Africa. But secondly, that Kumba had an obligation to convert 100% of mineral rights acquisition, and that indeed 100% was converted. And we'll let the court decide.
Yep. Well, we wait for that outcome. In the meantime, I mean, you're catering to this weak demand scenario, and as you said, it's very hard to push on some of these cost price pressures in that environment. We were chatting to a trader over at Nedbank Capital a little earlier, and he said, he asked the question on whether ArcelorMittal will consider or reconsider being aggressive in its pricing strategy, as aggressive as it's been in the past in its pricing strategy in the domestic arena. Is there room at this stage to ease back a bit?
Well, that would be predicated on the assumption that if we drop prices, people would buy more steel, but that simply isn't the case. If you need to build construct a building, you just need the steel. So there isn't that much elasticity that would back up a claim of that nature. That's the first thing. The second factor that you would need to consider is that, as a matter of interest, South Africa doesn't have any duties on the importation of steel. And where our prices begin to diverge from international norms, our customers import. We saw that in Q3. That was in Q3 of 2010, which is why we had a very weak fourth quarter. And that isn't happening. So our prices actually are not out of line with global norms. So the issue then is, are we supposed to subsidize the local market?
Okay, well, of course, some of the issues that are under consideration with all of this and within this very challenging environment, we've had the company still declaring an interim dividend of 55 cents. What's the rationale there? Because, again, commentators we've been speaking to, maybe they're saying part of a strategy to buy investor confidence at this stage.
We have a dividend policy which we apply actually pretty much straight down the line. We haven't seen a need to change that dividend policy. We declared a third of headline earnings. That's all we did. Now, at a certain point in time, if we were to believe that further down the road there's either good or bad signs, we may relook the dividend policy, but it is as such as it is. I dare say that our investors wouldn't be bought with a 55 cents dividend declaration, and neither did the board consider that to be a reckless move in any way. We've got sufficient cash to fund our operations through the next 6 months and beyond, so there would not have been any need to cut dividend.